We're just half an hour away from the open of trade in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne with Annabelle Droulers.
Our top stories: Asian stocks struggling for direction following Wall Street declines on signs of buyer fatigue. A strengthening dollar putting pressure on the region's currencies.
And a Bloomberg scoop: Canada is preparing potential tariffs on Chinese-made EVs, aligning with moves by the U.S. and the EU.
Also ahead, an exclusive interview with veteran investor Howard Marks on the investment landscape in China and beyond.
And more exclusives coming up. We speak to executives from Hong Kong Sasa International and Vitasoy about their latest results and the health of the city's retail sector. Look at the market action as we wrap up this trading week here. It seems like we're still, when it comes to risk assets, a bit on the back foot here this morning. Obviously, when we take a look at what we saw in the U.S., that jobless claims number did tick higher. We had contraction in some of the housing data as well. Interestingly enough, we did actually see Treasury yields heading higher across the curve there. So we stabilized a bit, but we're looking at what we're seeing in Australia and Japan, where yields are overall looking a little bit more elevated than usual. But it was interesting, right? It was really that dollar strength that really could be weighing on sentiment here today. You got to blame, or I guess you could thank, the SMB unexpectedly cutting rates once again. You had the BOE holding, but they also did talk a little bit more about, a bit of more of a dovish hold this time around, and that a clear sign from these MPC members that they might be ready to cut soon. So that invigorate the dollar trade. In fact, we're actually set for a fifth straight week of gains for the Bloomberg Dollar Index, and that's why this weakness that we're seeing in the Swissy here this morning, and the Japanese yen. Look at that, 159 levels here this morning. So, of course, the U.S. adding Japan into that intervention watch list, or FX watch list, I should say, does raise that intervention risk here. We're getting ever closer to those 160 levels that we saw, the lowest that we saw of this year, that could maybe prompt some intervention as well. Weakness in the currency in China certainly one in focus here today as well. You take a look at when it comes to how that NASDAQ Golden Dragon performed overnight. Maybe might help with sentiment here today, although we are starting to see a bit of a losing streak when it comes to Chinese stocks. We were down about 1% in some of these big ADRs and these tech plays as well. CSI 300, we're basically approaching this open set for 5 weeks of losses. So that is the longest losing streak we've seen in 2 months for that benchmark there. We're talking about some technicals, especially in the Hong Kong as well, which basically rebounded about that 50-day moving average. Some things to watch, but futures are slightly negative here this morning. 729 for offshore renminbi. So even for the offshore rate, we've reached the weakest of the year, Bell. And we got to watch that PBOC fix here today and whether they're going to push back on this weakness.
Yes, certainly something we'll be tracking. That's, of course, due in about 20 minutes or 15 minutes, rather, from now. But as you said, it's really all about the levels that we're watching in mainland markets. And as you said, that CSI 300, we actually closed yesterday below the 100-day moving average for the first time, going all the way back to February. A lot of selling coming through from overseas funds, and we've really seen the likes of Kweicha Moutai, for instance, the liquor maker, bearing the brunt of that. What else we're watching, as you said, it's that focus on what happens with Chinese government bonds. We're looking really at yields continuing to slide, particularly led by the longer end of the curve, but that 30-year yield holding below the 2.5% mark. So a lot of different global, local firms really looking to lock in these cheaper financing costs. On the data docket, you've got Macau visitor arrivals coming out. We have really seen those dwindling over the course of 2024. Hong Kong CPI, or inflation data, due as well. That is expecting to pick up, but only to 1.3%. So it's a very different story here to what you see in other markets. And EV stocks, of course, will be tracking those. We did actually have a scoop coming out that Canada could be looking to prepare tariffs on Chinese EVs. And we've got, of course, Min Min Lo in the studio with us here to talk about that in just a few minutes, Yvonne.
Yeah, before we get to that, we're going to get to the Fed discussion here. More Fed speak this week. And certainly has been one about caution, patience when it comes to what the next move from the Fed's going to be. We heard once again from the Minneapolis Fed President Neil Kashkari, who says the central bank's inflation target still remains out of reach.
It'll probably take a year or two to get all the way back down to our 2% target. The good news in all of this is that the labor market has remained remarkably strong. Wage growth is still pretty good for workers. By some measures, might be still a little bit too high to get back to our 2% inflation target. So getting all the way back to 2% is going to take a little more time, but I'm confident that we're going to get there.
Let's bring in Bloomberg's MLive strategist Mark Cranfield in Singapore. And Mark, what we hear from Fed officials continues to be this sort of need for patience, but markets are continuing to really test that sort of resolve. So what's the momentum that we're continuing to see for cuts, and is that misplaced?
No, I mean, people can see the data. The traders in the market, they can see that the inflation numbers are becoming more favorable in terms of getting close to the point where the Federal Reserve can actually lower interest rates, and they don't have much confidence in the dot plots. So at the beginning of the year, the Federal Reserve put in 3 chances for interest rate cuts, and that didn't work out very well because the inflation data went against them. Now they've changed it to only 1 dot plot by the end of the year, people thinking that could come in the fourth quarter, and now the data seems to be softening again. So traders are willing to look beyond what the Fed is projecting. They don't have a great deal of confidence in the Fed forecast, so they're more concerned about what the actual day-to-day data is telling them. And for now, it's moving in the direction of the Fed should be easing earlier rather than later. And of course, we've just had the Swiss National Bank have lowered interest rates for the second time in this cycle. The European Central Bank has already moved. Bank of England has given a big hint that there's an easing coming up sometime during the summer. So the rest of the G10 world is moving on, and the Federal Reserve is looking like the last man standing. So traders are probably saying it's only a matter of time before the Federal Reserve has to get in step with what the rest of the G10 are doing, of course, apart from Japan.
Well, apart from Japan, that certainly is one. I think China, I mean, these two markets and their currencies are basically still held hostage to this dollar strength here right now. Which one should I be more concerned about? The yen hitting 160 or dollar China hitting 730 now, Mark?
Should probably be concerned about both, really. They're very, very, very big currencies, and they have a huge impact on global markets. In the very short term, the dollar yen probably has more freedom to move around. Of course, the Chinese authorities, they use the daily fixings to help to moderate intraday fluctuations in their currency, and they do it very well. They help to modify volatility, but there's not much they can do about the wider world. And when people want to buy US dollars on a broad scale, obviously the Chinese currency is one of those that is up against the wall, particularly because China wants to keep its interest rates low. It may even want to ease policy again, and that obviously doesn't help its currency. On the other side, you have the Japanese authorities who want to tighten policy, but they're taking a very long time to do it, and the market can see that. So for the time being, the yield differential between short-term yields in Japan and those in the United States are so wide, they're barely changed. Even though Japan has already done 1 rate hike, it's still a huge differential, very much in favor of people who want to short the yen. And the way in which the Bank of Japan fumbled their message last week suggests they're not in a hurry, and the market wants to see them be more aggressive, but it's not happening. So the Japanese authorities can give as much verbal intervention as they want to, but it's really down to tighter monetary policy. Until that happens, the yen is really not going to improve very much.
Mark, thank you, Mark Cranfield there, MLive strategist, joining us out of Singapore. On to another story here. Bloomberg Scoop sources are saying that Canada is preparing potential new tariffs on Chinese electric vehicles in line with actions already taken by the U.S. and the EU. Let's get to our China correspondent, Min Min Lo. She's on the story for us. What more do we know at this point, Min Min?
Well, it's hard to say how much those eventual tariffs will be because Canada is said to be just starting this public consultation on tariffs, which could erect huge barriers for Chinese EVs going into the market. And President Trudeau is under huge pressure to really match those tariffs introduced by the Biden administration. We know the U.S. have quadrupled tariffs on Chinese EVs to upwards of 100%. The EU as well has imposed tariffs of up to 48%. And the strongest call for these tariffs is coming from Ontario. The Premier there saying that China is taking advantage of these low labor standards and dirty energy to flood the market with cheap vehicles and threatening Canadian jobs. The Canada's auto industry is also calling for steep tariffs. They're saying that Canada cannot afford to sit on the sidelines because U.S. is still by far their most important trading partner, and the review for that U.S.-Canada-Mexico free trade agreement is coming up. So President Trudeau, he will have to tread carefully here because there will also be fears of retaliation from China as well.
So then what's the impact that this could have on Chinese EV makers? Because we have sort of seen stocks sliding, but then they sort of gain when those tariffs were seen to be more contained and in line with market expectations.
Yes, so Tesla is going to be the most disproportionately affected because last year Canada saw this five-fold surge in electric vehicles from China, and most of that is driven by Tesla. And the Chinese EV makers like NIO, BYD, they haven't made great inroads into the Canadian market just yet. And currently the EV market is still a very small proportion of the overall auto sector. Only 11% of vehicles, new vehicles registered are electric vehicles, but that number is about to change because President Trudeau has a huge ambition. He set the target for 60% of new vehicles sold to be zero emissions by 2030. So that's a huge market right there, which the Chinese companies are potentially going to be locked out of in the coming years.
Min, that was our China correspondent there, Min Lo. And as we said, lots of different big interviews coming up on the China show. But one of those is an exclusive with the CFO of beauty retailer Sasa International. Danny Ho is joining us at the bottom of this hour for a check on how Hong Kong's consumer sector is continuing to struggle. That northbound tourism we continue to see as well. Counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. This is the China show.
All right, you take a look at when it comes to the pre-market, or at least futures here this morning, still pointing to negative here this morning, as of course we are clocking a week of declines, in fact a fifth week declines in the CSI 300. Hong Kong though has fared a little bit better here. We're still watching this bond rally in the CGBs. It looks like for now we're still sitting around that 225 level here, but 729 for dollar China. That certainly is a year-to-date low for the offshore renminbi, and that fix could come in as well, which we're watching very closely here this morning as well. Whether we see another weaker fix. Yesterday's was the weakest that we've seen since November. We take a look at when it comes to the survey, what estimated is 726 here right now. That range, though, is from 712 to about 728 this morning. You take a look at when it comes to one stock in particular that really has had a tough time, and it's Kway Chow Mao Tai, right? I mean, this is the liquor stock where basically was one of the key sort of stocks to have in every portfolio. It's really kind of losing that status now. In fact, and ICBC is likely going to surpass them here and being the biggest listed firm here. So taking that crown away from Kway Chow Mao Tai. Yeah,
really a tale of two different companies here, because on the one hand, you've seen a lot of investor concern around Kway Chow Mao Tai, particularly what we see in terms of their wholesale prices, because those have been really challenged and just reflects perhaps that weaker demand. So that general aversion, of course, to premium brands. ICBC, though, some very shareholder-friendly policies.
Yeah, so certainly that's one to watch here as well. So the banks, the liquor stocks, consumption stocks, the like here today, but certainly we continue to see not much really catalyst here in this Chinese equity market. And you take a look at how we're set up here. It certainly is one that we're watching next week. Certainly we're watching the property space in particular. There's a lot of wind-up hearings that we're focusing on among some of them. I think there's at least 4 or 5 developers that we're tracking here. Also that reference rate, there you go, 711.96. This morning there. So we're watching closely. It's still holding around that 711 level, but we'll watch and see really if that has any impact on the currency here today. It looks like at least we're off that 729 level right now. Plenty more ahead. This is Bloomberg. Just want to give you a bit more context here on that renminbi. So that's why you're seeing that bit of a drop here this morning. So it was the strongest fix, in fact, we've seen since April versus estimates here. So it's a bit of a whipsaw of what we saw yesterday there, where we did see a weaker fix. They were maybe taking advantage of U.S. markets being closed to maybe allow a little bit more weakness. But here you go today, a little bit more pushback from the central bank, Bell.
Yeah, certainly we'll be watching, of course, how it trades throughout the session here. But some of the other big political stories that we're tracking this morning in the U.S. has criticised what it calls China's its actions in the South China Sea after recent clashes with Philippine ships and crew. The State Department says Secretary Antony Blinken has repeated Washington's ironclad commitment to its defense treaty with Manila. The Philippines says a crewman lost a finger on Monday when a military resupply mission clashed with armed Chinese forces near a disputed shoal. Russian President Vladimir Putin isn't ruling out providing North Korea with high-precision weapons after signing a defense pact with Kim Jong-un. Putin says Russia reserves the right to supply arms in other regions, comparing it to Western nations' military support for Ukraine. The Russia-North Korea pact is also prompting South Korea to consider ending its own ban on sending lethal weapons to Ukraine. An Israeli military commander has appeared to suggest that Prime Minister Benjamin Netanyahu's goal of destroying Hamas is unachievable. Rear Admiral Daniel Hagari told Israeli TV that Hamas is an idea and anyone who thinks it will vanish is mistaken. Netanyahu, meanwhile, says Israel will not leave the Gaza Strip until Hamas's military and governmental capabilities are eliminated.
Well, the head of Tibet's government-in-exile is calling on other countries to join the U.S. in pressing China for direct talks. Pempa Zering spoke to us as a delegation of U.S. lawmakers visited the Tibetan spiritual leader, the Dalai Lama, in the Indian town of Dharamsala. Now, he gave us his response to new U.S. legislation boosting support for Tibet's exiled leaders.
Now, this Tibet Resolve Act is a significant law once President Biden signs it into an act in the next few days, because this act talks about China's disinformation on Tibetan history. After I came into this office, we decided to change our strategy a little bit, even though we are committed to the middle way policy of His Holiness the Dalai Lama, trying to seek a non-violent, negotiated, mutually beneficial, lasting solution to the Sino-Tibet conflict. But if there is no recognition to the polarities, when we talk about middle way, there is a middle way only if there are polarities. In this case, it could be multidimensional polarities, but in the political sense, one polarity is the situation of Tibet right now under the repressive communist government, and the other polarity is the historical status of Tibet as an independent state. So we have not been just doing the talk, but we have been working very closely with the U.S. Congress since June 2022, where we had the first hearing or testimony on the historical status of Tibet in the U.S. Congress for the first time.
On the ground, as the leader of the Tibetan people and the government of Tibet in exile, how much of a difference does this make? How much does your life change or your work change with this bill being passed and President Biden likely to, clear it as law?
For China, sovereignty is a major issue. And that is also the reason why we thought we addressed their major concern when His Holiness proposed the middle way. So by focusing on the historical status, it's more like we are trying to wrestle with China by holding their horns. So this will be a new dimension to our struggle. This will be a new tool in our hands to reach out to other governments and see whether they can take similar position as the United States, and which would force China to come and negotiate with us.
Prime Minister, there were some reports that your government was in some kind of back-channel talks. Can you give us an understanding? When did that start? Where is it now? And what do you expect out of it?
Well, there was some outreach since January last year, so it has already been 1.5 years already, and but there's nothing concrete to talk about. It's just interlocutor that I have appointed, and there are interlocutors from Beijing side, and we just relay messages to each other. If you look at what President Xi Jinping is doing to the whole of China, and more particularly the nationality regions like Tibet or East Turkestan or Mongolia, and more so in Hong Kong, it doesn't look very likely that we can have too much expectations out of these things. The first thing would be to re-establish contact. Even that has, in the last 1.5 years, we have not been able to do that. So it's still stuck there based on some of their thinkings and how we perceive our things. So there is nothing concrete to talk about. And we don't have too much expectations if you look at what Xi Jinping is doing. But again, if you ask me, when you don't have expectation while you're still dealing with China, we can't think only short term. We have to think long term. We travel around the world, speak with governments, and they assure us that there are a lot of diversification going on, there are a lot of de-risking going on, but not so much visible right now because decoupling is almost impossible because some countries have a lot of investment in China. But eventually, I think it should take its shape. And as we travel around the world, now more and more people want to understand China for what it is. And we have lived with China for centuries as neighbors. And we know that China respects only strength, not weakness. So we ask people or countries to stand up for their values of freedom and human dignity and democracy and all those things, which they so cherish in their own countries, which is taken for granted that is not there in China.
That was Ben Passaring there, the Prime Minister of the Tibetan government-in-exile, speaking with Bloomberg's Sudi Ranjan Sen. And China's Foreign Ministry, as well, to point out, yesterday addressed the US lawmakers' visit to the Dalai Lama at a regular press briefing, saying, quote, the so-called Tibetan government-in-exile is an out-and-out separatist political group and an illegal organisation in total violation of China's constitution and laws, Yvonne.
Yep, here's the pre-market in Hong Kong, and we're seeing things looking still a bit in the red. So here we go. HS Tech is down about 1.2%. That's really dragging the overall Hang Seng Index down. We're sub 18,200 here right now, and H shares are also falling as well. Though that stronger fix, at least today, is helping to at least offset that weakness that we saw yesterday. So we're at 728 levels for dollar China this morning. Let's get to our next guest. Just wrapped up, or just started a regional tour visiting clients in Asia and also attended the Liu Jiajui Forum in Shanghai. Howard Marks is co-chairman of Oaktree Capital Management and joins us now from Tokyo. Howard, it's always great to talk to you. Thanks so much for joining us, and welcome to Asia, of course. It's interesting, right, when you talk about, I know your favorite topic is talking about risk and how to look at risk-taking here. When you can argue that the U.S. cycle is getting, I guess, towards the late side part of things, Asia in some ways is still in the thick of it and re-emerging from this pandemic in some ways as well. How are you looking at these diverging cycles around the world here right now? And is it a time still to be a contrarian?
The U.S. had a brief period of difficulty in the second quarter of 2020. The economy rebounded very nicely in the third quarter and has been doing very well since then, despite the fact that interest rates have not been cut. There are people arguing for stimulus, but so far they haven't gotten it. It doesn't seem there's a need to stimulate, given how well the economy is doing and how well labor is doing. Obviously, as you say, other countries are not quite doing quite as well. There seems to be some asynchronous elements in the global monetary picture. I think that most things are going in the right direction. People are very happy investing in the United States. They like our legal system, economic system, corporate sector, and the only thing that's challenging about the U.S. is that a lot of those merits are priced in.
As Yvonne was saying, though, that focus on risk, and you do talk about it a lot, and most recently making that analogy to chess, where do you see then the risk that are either real or perhaps more modest, but where are you seeing those at the moment, those opportunities?
Given that the U.S. is priced highly, a lot of the opportunities for bargains are outside the U.S. Obviously, China is on a lot of people's uninvestable list. That tends to depress its value, and we like to look at things that other people aren't interested in. So China is one good example. We are not macro investors. We're not top-down. We don't affect a geographic diversification for its own sake. We go where the bargains are, and we're finding lots of bargains in many places.
Howard, it's interesting, too. I mean, can you tell us a bit more about the fundraising environment maybe in Asia here right now? I mean, you're listening to, asset managers like Apollo that's pushing into insurance, into wealth here right now. And at a time when we're seeing rates where you are in Tokyo, as well as in China, are still quite low, how would you describe the fundraising environment now?
The fundraising environment is good. There's a lot of interest in credit. Our sectors were in hibernation for a long time. Just 2.5 years ago, cash yielded 0, and even high-yield bonds yielded only 4. Today, they yield close to 8, and from there, it's onward and upward in terms of yields. So credit investing can be very rewarding today. There's a lot of interest in credit investing as a result. We try to be judicious about our pace of investing and our pace of fundraising, but the desire is there on the part of clients, and we continue to make inroads.
And what's been really interesting, because it's been that real explosion in private credit, and you've seen a lot of banks as well getting involved into it. But what's the role then that you see private credit playing in the financing market, and also the relationship with traditional lenders as well? Complementary or competitors in this landscape, do you think?
I think mostly complementary. The banks in many parts of the world have pulled back. Even as long ago as the global financial crisis, and higher regulation, higher capital requirements, and so forth. So there has been a place for non-bank lenders. There continues to be. So I would say that so far the non-bank lenders have mostly picked up the slack that the bank lenders created. If the banks come back in full force and the non-bank lenders continue strongly, we could find competition to lend, and that's usually not a great thing for lenders. We don't like to see an oversupply of loan capital.
And do you see any sectors or geographies that are taking more advantage of private credit growth in particular? I know you mentioned as well those opportunities you see in the China market.
The private credit opportunities are very strong in the U.S. and also strong in Europe. Other than that, it's fairly spotty. The onslaught of private credit has not hit Asia to anything near the same degree.
And Howard, you mentioned about China giving you good opportunities outside the U.S. I mean, in particular, I know you guys focus more on the loan side of things when it comes to your distress strategy in China. I mean, how are you viewing distressed properties now in the mainland? Is there a sense that you're adding to your exposure in any way, or backing away from this sector now?
We've been investors in NPLs for close to 10 years, non-performing loans, that is. Every banking system generates some non-performing loans. China has set up mechanisms to get them off the bank's books. And we've been participating for, as I say, close to 10 years. The legal system has operated as it should. We're happy to continue in that role, and we're not backing away.
In terms of, obviously, you were kind of caught up in what happened with Evergrande as a creditor. I'm just wondering, were there any lessons that were learned from this fallout from Evergrande and this downfall? And how much of the assets was Oaktree able to salvage?
The lesson is to be careful when supply is created by strong availability of capital. Capital was made available to the property development sector so that it could contribute to GDP growth. It expanded rapidly. It made use of that capital. It built some buildings which from time to time turned out to have supply exceeding demand. We participated. I think another important lesson is it's a good idea to get collateral. We got collateral on our loans to Evergrande when many others didn't. And we think we're coming out very well. As I mentioned, the legal system is performing for us. We have gotten control of the collateral, and there haven't been any disappointments on that front. So, as I say, we're continuing with our involvement.
Howard, I'm curious because you've made it to Tokyo, of course, and what are the kinds of conversations you're having with investors there? What sort of investments are you also looking at in the country?
Most of our involvement in Japan is investing outside Japan for Japanese investors. The yields are fairly low in Japan and generally speaking not additive to our global portfolios. But Oaktree has been maintaining for over a year and a half a thesis we call sea change, which says that unlike the preceding 13 years, interest rates in the coming 5 to 10 will not be characterized by constantly declining rates or ultra-low rates. That's our thesis. That means that opportunities to make good money with the risk under control in credit investments is strong and will persist. That's mostly what we're talking about here. And, we're conducting a conference this week for our first regional conference for Asia, and I must say that the reception is very positive.
Yeah, and certainly there's been so much spotlight on Japan recently. It's interesting. I was reading your latest memo on impact of debt, and you mentioned about a lot of these ultra-durable companies in Japan, where there's more than 100 that have been operating for hundreds of years. And the key thing that you notice is that, they have a lot of cash and they're not sitting on a whole lot of debt right now. Do you think this is just a symptom of just, once again, overly cautious sort of corporate management? Or have we seen a sea change in Japan in some ways, given this wave of corporate governance? Or is this just a function of improving fundamentals that we're seeing among Japan Inc. now?
No, I think that the Japanese culture is essentially conservative in nature, and other than a little burst in the 80s, really never embraced aggressive financing and the high use of leverage. And as the memo said, as you say, non-use of leverage is one of the things that can allow you to survive for very long periods of time. There's a lesson in that, but I think that some leverage is good, but each person or each organization has to identify the level of leverage that's consistent with its circumstances and will lead to long-term survival.
Howard, you mentioned the need sometimes for having collateralized loans, and it makes me think about Inter Milan, of course, and Oaktree took control of that sporting club last month. What are your plans for it? And are you also looking at other sports investments, given you've got a long link with those as well?
As I say, we're not strategic top-down investors. We don't say, let's go out and get involved with a bunch of sports teams. Rather, we make loans when presented with the opportunity where we think we'll get repaid. Where there's some question about repayment, we like to get collateral. Of course, the Milan situation, Inter was one of those. We made a loan to a borrower who collateralized it with the team, didn't pay us. We ended up as the owners. It was not our intention, but we're happy with the outcome so far.
We're going to pivot once more. I mean, you talked a little bit more about, Howard, a lot of the good news, or maybe in these U.S. markets are priced in. A lot of that, has to do with AI in general. I mean, can you tell us more about this AI hype and what this all means? When we are in the U.S. cycle, I mean, is there a bubble risk still?
Of all the people you're going to have on the show today, I probably know the least about AI. I'm good at identifying optimism. Obviously, there's optimism surrounding AI today, and it is to some modest degree pervading the market. But I think that AI will not have a profound impact on non-AI companies for a good period of time. And whenever you have a new thing like AI, there is usually some aggregation of optimism, and you certainly have it today. And but whether the optimism is appropriate or excessive, you'll have to find that out from somebody else who knows about it.
All right, Howard, thanks very much for taking the time to speak with us. That was the co-chairman of Oaktree Capital Management. There are lots of key takeaways, but one of those, not backing away from China loan investments. And we do have mainland markets just heading 10 minutes into the session so far, and it's pretty much weakness across the board here today, being led actually lower by what the losses that we see there in the Hang Seng Tech Gauge, so you're down 1.6%. Broadly, it was that story of investors perhaps just losing a little bit of momentum in the overnight session on Wall Street. We saw NVIDIA pulling back in particular. Let's change on now, take a look at some of the movers in focus. We've got Vitasoy, of course, or Vitasoy. That stock is declining here this morning after dropping reporting actually better than expected results. And we've also got Sasa International just coming online, the beauty retailer. A slight move higher here, and we've actually got the CFO of Sasa International, Danny Ho, joining us in just a few minutes' time. We'll have more ahead. This is Bloomberg.
Welcome back to the China Show. Hong Kong-based beauty retailer Sasa International reported net income for the full year that jumped almost fourfold from a year earlier, although it does short of analyst estimates. The results do come amid a retail environment in the city that does remain challenging. For more, let's bring in Danny Ho, CFO of Sasa International, joining us here in the studio. Danny, thanks so much for joining us once again. Yeah, overall, I mean, it seems like we've come back from a big way from last year, which certainly you could say was a low base. But overall, what was your take of the year?
Tale of different quarters. Where the first three quarters we had quite significant double-digit growth, and then for the last quarter, a tougher quarter where we had more of a northbound travel from local Hong Kong residents into China. So a bit of headwinds there. But you also saw that we grew in our China market online sales. We grew 74.5% in the second half of the year, which was very pleasing. And also in Southeast Asia, towards the end of the year, we started to see some growth. We've now got 5 stores in Singapore, and that is helping us generate growth into the first quarter of this year as well. But going back to last year, actually, as you mentioned, we went from an adjusted loss of $55 million to a profit this year of $218 million. So a big turnaround for us, and we're also very pleased that after a 4-year hiatus, we managed to pay out a dividend again. So we were always a high payout ratio company, and we're now back to 70%, and we hope to continue that into the future.
Stores, of course, in Hong Kong, you are still trending below where you were pre-COVID. I think it's about 40 fewer than pre the pandemic. How are you planning to expand that network, or do you have plans to expand the network, given, as you said, you're seeing perhaps a pickup in online sales?
So if you look at our tourist mix right now, we're around 48% tourist mix in Hong Kong, Macau, and pre-COVID was 73%. So in terms of the 40 stores that you talked about, we actually keep tabs on where there are locations that we'd like to be in, but we're also monitoring the traffic coming into Hong Kong. So if you look at, as I say, the last quarter and into the first quarter of this year, it's almost 4x in terms of local Hong Kong residents moving into the Greater Bay Area versus Chinese consumers coming the other way. I think a couple of policy changes might help us. One would be the tax-free spend for Chinese tourists when they come to Hong Kong, which is about $5,000, and it's been like that for over 20 years. And also in terms of multiple entry visas, those kind of changes would really help us. And I think when those happen, we'll be looking at expanding our store footprint.
Can you tell us a bit more about that customer mix right now? I mean, mainland, tourists that are coming in, It seems like that's slowing from back in the good old days, but how much do they contribute to your overall Hong Kong sales now?
As I said, it's about 35% in Hong Kong, but it's about 80% in Macau. So mixed in combined, it's about 48. Actually, if you look at the spend per mainland per ticket per mainland visitor, it's almost double for a local Hong Kong resident. Obviously, as you know, when we're on holiday, we tend to spend more. So it's a big contributor. And I think, as I say, policy changes is one reason why that hasn't sort of recovered to where it was.
How concerned are you, aside from the fact that Chinese consumers aren't coming here as much, or mainland Chinese consumers, what about the northbound travel instead? Because especially when you've got the likes of Costco, for instance, that's setting up or is already set up over the border, how is that competitive landscape changing?
Yeah, it's quite different, but it's quite exciting as well. I think if you look long term, it's a good thing that Hong Kong is now integrating into the Greater Bay Area more, and it's a good thing that consumers have choice. But it means that we have to be on our toes in terms of what we do. So we're actually looking at a lot more exciting promotions to excite our local Hong Kong residents. By October, we will have a new VIP CRM system in place. We'll integrate our point system across the Greater Bay Area. So those kind of things we think will be positive for us. If you also look at our gross profit margin, which has been quite impressive for us, is that we grew that 1.5 percentage points to 45.5 this year. And what's behind that is that we're actually promoting a lot more exclusive brands. So our exclusive brand mix is around 36% at the moment, and that's moved up 3 percentage points this year as well. For those, if you look at our margins on exclusive brands, it's about 4x versus a parallel import or a big brand, and therefore, if we have exciting promotions on that front, if the sales mix increase will actually more than cover the gross margin loss on that. So I think there's more we can do, and there's a lot we can do, and I think we have those in plans for the second half of this year.
Yeah, I mean, I'm just wondering, in terms of when you expect things to recover in Hong Kong. I mean, I think in terms of your offline sales, Hong Kong, Macau is still less than half of what it was back in pre-COVID levels here. Do you think that sales will ever recover? Do you have a time frame at least, or is this sort of the new normal that SASA has to deal with now?
Yeah, I think 1 year ago when the borders first opened, we were worried about whether Chinese tourists would come at all and whether they'd spend at all. What we've seen now is they come and they spend, and the ticket size is actually very comparable to pre-COVID. What's different right now is the numbers. And I think while the China economy is the way it is, then that will drag on. But I think we always say that if we had 3 years, we'd probably get to about 67% of where we were in Hong Kong, Macau. But we're also looking to expand in Southeast Asia and in mainland China itself to make up the difference. So I think long term we're quite positive about what we want to do and where we want to go, but not necessarily it won't be the way it was.
Yeah.
Yeah, because it's also just changing preferences, and you mentioned niche brands, but how much more money can you make out of niche brands than ones that are more mainstream?
I think that's one big positive thing now is that both the mainland Chinese consumer and also local consumers, also in Southeast Asia, is that they're less obsessed about big brands, more willing to try niche brands, and that gives us a bit of room to play with. And I think we've always been a traditional retailer, but what we're trying to do more of now is move into the brand management piece. So in terms of that, we're looking at distribution channels in mainland China itself and also in Southeast Asia.
You mentioned about some of the changes on the border that could help, right? Multiple entry permits, increase in duty-free allowance. I mean, have you had discussions with the Hong Kong government? Are they willing to look at some of these changes or measures? Yeah,
I think we've been lobbying them quite frequently. I say not just us, but also the Hong Kong Retail Management Association over the past 6 months. I think the hurt across retail in Hong Kong has been felt by everyone.
Yeah.
There are plans. There are plans to increase the 5,000 RMB to 30,000, but that's in discussion, and in terms of multiple entry visas, but these policies are not driven by the Hong Kong government, but more on the China side. So yeah, and it's our voices are loud and clear, and I think changes are ahead, but maybe not so immediate.
Of course, China, there's the currency impact as well, and we've been tracking the moves in the Chinese yuan heading to that 7.3 mark. But how is that impacting your business?
Well, again, likewise, for a Chinese consumer coming to Hong Kong, nowadays what we hear is that they tend to stay across the border in Shenzhen and travel in. One, to do with the cost here, and also to do with the RMB. It's obviously weaker than it was, and just like Hong Kongers that during holidays nowadays tend to travel to Japan. I'm actually off to Japan tomorrow myself, but so currency does impact how much people spend while they're on holiday.
You mentioned about expanding overseas, Southeast Asia. What's driving that sort of expansion in Southeast Asia?
As I say, we're looking at how we can increase our footprint and how we can make up the gap to where we were.
What markets are you most excited about there?
We're looking at Indonesia, we're looking at Vietnam. I think the thing with Sasa is the brand is very strong. It's been around for 46 years. So we do have partners looking to cooperate with us, and I think that works well for us as well. So we don't necessarily need to set up stores immediately, but through a distribution network, we can test the market. And again, with the niche brands that we have and the relationship we have brand owners, that again is something we can do that they can't necessarily do themselves.
You mentioned that dividend payout ratio of about 70%, plans to extend that, but just talk us through what led to you increasing it and how sustainable you think it is as well.
Yeah, not necessarily increased, but if you look at last year, we actually refrained from paying out dividend even though our cash flow improved. So this year our cash flow outpaced our profitability for the year, and that's through managing our inventory. So we're quite confident that going ahead we can maintain that kind of a policy. If you looked at pre-COVID, we actually had an even higher payout ratio, so we're quite confident we can kind of retain that.
All right, Danny, thanks so much for your insights there. That was Danny Ho, CFO of Sasa International. We're seeing that stock just moving a little bit higher, 2.5% in the green. We're going to stick with earnings, though, and we're going to be hearing from Hong Kong-listed F&B company Vitasoy International's Group CEO Roberto Guidetti. He joins us at the bottom of the next hour. That exclusive interview is ahead. This is Bloomberg. All right, taking you to some live pictures here of the SoftBank Group annual general meeting that's taking place this morning in Tokyo. Masayoshi Son here talking about plans around AI, and we're hearing from Son that he thinks that artificial superintelligence can be realized in the next decade. Of course, the focus of the AGM very much relates to SoftBank's investment plans. We've really seen them sort of sitting on the fences, holding back. Now there's this sense that perhaps the Japanese conglomerate is on the cusp of making a very major investment in AI. Of course, Son as well, a little bit pragmatic about this. He's saying there's a chance, of course, it could be a big hit, and of course you want that, but he's also saying it could be a bad flop as well. SoftBank, though, saying it has no choice but to try. So SoftBank, a stock we're watching closely this morning, just trading a little bit higher, up 1% at this point in time. Of course, actually bucking the trend, given we have seen stocks in the tech space really sliding this morning and a pullback in the likes of Nvidia. But a check on other markets as well.
Yeah, we're looking at SenseTime shares here this morning. We're seeing a second day of losses here, but they did announce this share placement about $264 million. So there is a bit of fundraising that's going on here, though. But yeah, our very own Robert Lee from Bloomberg Intelligence saying the outlook still remains quite challenging for SenseTime despite this fundraising as well. So that's one thing we're watching very closely. In terms of other markets as well, we're watching when it comes to Greater China, and this is what the setup is or how things are looking at right now. So we're about a little over half an hour, close to half an hour into the session. 1% losses here when it comes to Hang Seng now. So I believe that is the session lows for now. We're 200 points to the downside here. Onshore and Shanghai looking a little bit better. We're basically flat on the CSI 300. And your currencies are looking like this here. That stronger fix certainly did help at least stabilize the currency in some ways. We're talking about dollar China now at 728 levels. Welcome back to the China Show. Here's a look at the CSI 300 a half hour into the session here. And relatively speaking, it is a bit wet out there, but we're doing a little bit better than the rest of Greater China markets here today. See, the Hang Seng has been as much seeing declines of 1% or so. So the CSI 300, though, we're still on track for a fifth week of losses for that gauge. And it is the longest losing streak we've seen for a few months now. So certainly that is one to watch here. But Belle, what else are you watching out for now?
Well, keeping a very close watch on what's happening with EV stocks this morning, because we are just seeing some of those weakening in the Hong Kong session so far. What is really driving that, of course, is the scoop we actually had from Bloomberg talking about Canada looking at potential tariffs on Chinese electric vehicle makers. this would be, of course, in line with what we saw from the US and Europe, but the read-through that we're getting from our Bloomberg intelligence team is that China needs to be very careful when it monitors any sort of expansion plans or these EV makers that are pushing to earn money from overseas. That could really be dented, again, by these extra levies that could be applied to their products. So watching those EV makers in particular, BYD, though, actually had earlier declined as much as 1%. It is now turning positive. So we'll see if this effect is perhaps a little bit short-lived, if those tariffs are indeed in line with what we saw from other major economic powers. But let's take a look also what's happening in Asia ex-China this morning so far. The story here is really that weakness that you're seeing across the board, pretty broad-based. The Nikkei is actually trading fairly flat right now, and Australia's also just moved to unchanged territory. But you've got those declines that you're seeing there for Korea, also Taiwan stocks, and that's that story of that tech pullback across the board. Also, Yvonne, so much reaction to central bank decisions and a stronger dollar that we've seen.
Yeah, I mean, that's what you can blame the stronger dollar on that, right? When you have the Swiss National Bank cutting rates unexpectedly again. So that certainly did at least lead to that weakness in the Swissy and then some more strength in the dollar. And then you add the BOE to it, right? I mean, they did keep things on hold, but it was quite dovish. And you get more of a sense from these members that they're looking at really a rate cut cycle pretty soon.
Yeah, getting really ready for it. The BOE saying that first hike could come as soon as August. So you do really feel for Rishi Sunak because he's going to be having that reduction possibly after the general election that he's called, and really looking for a sort of a wipeout there. But there are, of course, always the contrarians in this landscape, and Norway has really been one of them. They're saying that they could actually hold off any sort of rate cuts until next year instead. So they're really at odds with the advanced economies. And Indonesia as well, we had yesterday afternoon, they held their rate, but they're vowing steps to get that rupiah below the 16,000 mark. The rate there at 6.25%. We actually have seen it holding on to its declines.
Not to mention you've seen a yen that's basically been down for about 7 sessions now. I think it's one of the longest losing streaks we've seen, and we're getting very close to that 160 handle, which in some ways, does it prompt that sort of intervention risk here? Of course, we have Japan jumping or being put on that FX watch from the U.S. And it's interesting, we're watching those levels, right? 160 is certainly where we saw the last intervention. 160.17, that's when you start getting to those levels where, we're getting to those 34-year lows or something when it comes to the yen as well.
Yeah, it certainly does seem to be the line in the sand for Japanese government and policymakers there as well. But, of course, more lines coming through from Fed officials, and one of those was the Minneapolis president, Neil Kashkari, who says the central bank's inflation target remains out of reach.
It'll probably take a year or two to get all the way back down to our 2% target. The good news in all of this is that the labor market has remained remarkably strong. Wage growth is still pretty good for workers. By some measures, might be still a little bit too high to get back to our 2% inflation target. So getting all the way back to 2% is going to take a little more time, but I'm confident that we're going to get there.
Let's bring in Tony Sycamore, market analyst at IG Australia. And Tony, it's interesting, just all this Fed speak that we've heard of. Markets don't seem to be listening too much. But I'm just wondering, now that we're seeing this jobless claims number that came out yesterday that was a little bit ticking higher, you're starting to see maybe, as Goldman called it, like inflection points in the labor market. I'm just wondering, is the Fed now behind the curve?
It's a good question. I mean, there's issues with inflation still lurking in the background. And when you think about the way the pendulum has swung this year, we've gone from 6 rate cuts at the start of the year to about 1 3 weeks ago. We're back at around 2 rate cuts priced at this point of time. I'm not convinced it's the actual amount of rate cuts or the timing of rate cuts, which is quite so important at the moment. We know that after the Fed pivoted at the end of last year, it then started talking about rate cuts. And I think what that does, we're seeing actual discussion of rate cuts almost having the same impact of the actual delivering of rate cuts in terms of its loosening financial conditions. So you're already starting to see the way that those loosening financial conditions have supported the real market, but whether they, or the equity markets rather, but whether they get in there and they can support the real economy is another question. But what it has done is just by implying these rate cuts, the Fed has actually left itself with plenty of bullets for when it does need them. And as you've noted, we've seen a period of soft data in recent weeks, normalization, if you like, and that's a really good position for the Fed to be in, because they still have plenty of bullets left for when they need to use them. And I think that's a really good position if this data does continue to soften. It might suddenly go back towards 3 or 4 rate cuts before end of year.
Just on that point, actually, of what we're hearing from Fed officials, the former St. Louis Fed chief Bullard is talking about his expectations around rate cuts, saying that they will be slow for this year, and also the US growth outlook remains robust. But I'm curious for your views, because last hour we had Howard Marks from Oaktree Capital talking about the outlook for the Fed, but also earlier this week he spoke about the outlook for inflation, and he's saying that getting back down to that 2% mark is going to be unrealistic. Do you agree with that sentiment?
Yeah, I do. And for the reason that I just spoke about, so we're implying Fed rate cuts, they're not actually delivering them, but that also makes it harder to manage inflation and inflation expectations. And that will mean getting back to that 2% target is more difficult. I suspect that's probably behind the RBA's thinking. I mean, they've been warning of possible rate hikes, potentially with an eye to what's happening in the US. Inflation has remained stubborn over there. I suspect the RBA probably want to cut rates or promise rate cuts at some point of time fairly soon, given the way we're seeing GDP data start to slow. We're seeing retail sales start to slow. Very similar to what's happening in the US in some respects. But they know that if they go out there and start alluding to rate cuts, that we get this situation where it is difficult to control those inflationary tendencies or expectations, which are still prevailing in the market at this point of time.
So once they do embark on this, rate cut cycle, I'm just wondering, what asset class is going to benefit the most? Do I double down on this equity rally, or do I look at more than fixed income space now, Tony?
Well, the equity rally, you cannot argue with that price action over the past 6 to 12 months. I want to buy a pullback in equities, and I can tell you why I think we're going to get a pullback into equities, for the same reason we saw a pullback at the end of last month. Now, we have these big pension funds, these real asset managers, which have to get back to benchmark weightings for their end of month reporting. And when you've seen a particular sector or a stock outperform, for example, say how the NASDAQ or NVIDIA has done, they need to start selling those. Now, compounding your usual month-end flows, we also have end of quarter and end of financial year for some institutions as well. So my sense is that we are going to see the pullback, which started last night in some of those outperformers like NVIDIA and the NASDAQ, continue into the end of this month. Now, the very low for the NASDAQ last month was the final trading day of the session. Then what happens? These portfolio managers, these fund managers, they don't want to let go of that exposure. So straight away at the start of the new month, they put that exposure back on. So yes, I want to buy dips in US equity markets, and I think we're going to get that chance into the end of next week. And I don't think there's any reason why we won't see a repeat of last or this month, June, i.e. July. We see a strong start as those fund managers go overweight in those winners, those AI stocks, which they want to continue backing into year end.
Tony, though, do you think that pullback, if we get it, do you think that's just going to be technical based? You don't think that there's any sort of bubble forming in AI stocks in particular, given there are concerns that we're not really seeing it impacting the profitability of a lot of companies?
You're spot on. I mean, valuations, they're expensive, but they're not at bubble levels. Some of these companies are already reporting profits from their investments in AIs. Many of the companies, hugely impressive balance sheets, very unlike like what we saw back in the dot-com era. So, yeah, I think these companies are in a very good place. It was only 12 months ago that we all started hearing about ChatGPT. This has got further to run for me, and I think that any pullback, whether it be technical in nature, i.e. this rebalancing phenomena which we've seen, I think it gives you a really good entry point to get back in, because I just can't see this story running out of steam into year end.
What about in terms of cash? I mean, I take a look at what money market funds are doing. They're still seeing quite a bit of a stockpile there, Tony. If those are still earning you some 5%, is there any other sort of asset class beyond stocks that can give you that sort of return?
Yeah, well, I mean, cash is very attractive at this point of time, and there's a good argument to have a good allocation to cash as well. But by the same token, the way, I mean, we look at the NASDAQ, it's up 18% year to date, and we're only halfway through the year. So having that money in a cash trust is nice, and it gives you that security. But I guess if you're looking for more aggressive places to put your money, then certainly the NASDAQ is the place to be. Other markets that I like the look of, for example, the Nikkei. The Nikkei's dealing with uncertainties at the moment. You mentioned the fact that dollar yen's getting back up towards that 160 level. But I think once these uncertainties are out of the way, you will see the Nikkei uptrend resume, but not before a pullback. I think you're going to see a pullback towards 35,000, 36,000. I think that gives you a wonderful level where you can choose to be topping up that exposure to Asian equity markets as well.
And Japan, do you have sort of any year-end targets for the Nikkei in particular?
Yeah, I think it's going to take out that 41,000 high we saw 3 or 4 months ago. I think we'll end the year closer to 42,000. So right here, right now, we're muddling through for good reason. As we said, we've got the uncertainty. I think the BOJ probably want to exit on their time zone or move further towards the exit door, but the market's not giving them that luxury in many respects. So dollar yen right here, right now, it's in the hitting zone. And if dollar yen falls 2 to 3, 4%, that's going to weigh on the Nikkei as well. So that's potentially the catalyst for that pullback, which I'm talking about. Also, this final or the reduction of these JGB purchases also needs to play out as well. So there's quite a few catalysts. And if you're a macro fund sitting in Asia or in Europe or the US, you probably don't want to be buying the Nikkei while these thematics still need to play out. But if we get to August or September and the Nikkei's had that clean out of positioning, if you like, that stale positioning, then I think you look for that Nikkei to the uptrend to resume, and 42,000 looks like a good target for me.
Tony, you're also looking at gold. I'm wondering this pullback in gold. What should I do with that now? Now that people are still questioning about what the rate cut cycle is going to look like from the Fed. Should I get back into this sort of trade now?
Right. Well, the ECB's already started. We saw the Swiss National Bank cut for a second time. The Bank of England edging closer to its first rate cut as well. And the Fed, I don't think, is going to be long behind that. So for me, it's a really supportive environment for gold. Technically as well, the pullback from the 24.50 high has been extremely constructive, held a really nice band of support coming in around 22.75, and providing gold continues to hold above that support band, I think it'll break that 24.50 high into year end and probably head north towards 2,500. So that's how I'm seeing gold at this point of time.
Tony, thanks so much for joining us this morning. That was Tony Sycamore there, market analyst at IG Australia. And coming up, more exclusive interviews ahead. We're going to hear from the Hong Kong-listed F&B company Vitasoy's Group CEO, Roberto Guidetti. He joins us just at the bottom of the hour. We're seeing that stock there pairing some of its earlier losses. But broadly, we do see the Hang Seng in the red, down 1% today.
All right, watching the EV sector in China this morning, mostly lower here as we take a look at this Bloomberg scoop of Canada preparing tariffs on Chinese EVs and following what we could be seeing out of the U.S. as well as the EU. Let's get to our China correspondent, Min Lo, joining us now. Obviously, they are following. They face a lot of pressure, Justin Trudeau's government, to do something. How are they going to proceed?
Yeah, it's hard to say how high those tariffs will eventually be. They're just starting public consultations on this now. But there are strong pressure, as you said, from domestic and foreign quarters to increase those tariffs, and especially from Ontario. That's the most populous province of Canada and also an auto manufacturing hub. The Premier of Ontario is saying that China is taking advantage of these low labor standards and dirty energy to flood the market with cheap EVs and threaten Canadian jobs. And Canada's auto sector as well is calling for steep tariffs. They said that Canada really cannot afford to sit on the sidelines because you have that Canada, US, Mexico free trade agreement that's coming up under review. And we know that Canada's auto sector is very tightly integrated with the US one. They sell parts and finished products to the US. By far, most of their exports are going into the US. So President Trudeau really has to balance between US and China here. And there's a fear of retaliation from China as well.
We haven't got the exact numbers for China's imports, or rather Canada's imports of Chinese EVs, but if you take the US as a guide, where they really don't have big numbers of Chinese-made vehicles coming into the country, is this more bark than bite, do you think, or is there going to be a bigger impact here for China's EV sector?
Yeah, you're right. So there isn't likely to be a huge short-term impact for Chinese EVs because Canada is still a very nascent market for them. But of course, the risk is that they will be locked out of the market before even they made inroads into the country. And last year, Canada did see this five-fold surge in electric vehicles from China, but most of that is driven by Tesla, Chinese-made Tesla. So Tesla is going to be disproportionately affected in the short term. Currently, Chinese EVs are tariffed at only 6%, and consumers also enjoy this federal rebate program to buy foreign-made EVs, and that's part of President Trudeau's ambition to really increase the number of new vehicles, light-duty vehicles, to be zero emissions by 2030. They want that target to be 60% by 2030. So it's a huge potential market there. But of course, Canada is also pouring billions to build up its own domestic EV industries, with multi-billion-dollar subsidies going into companies like Honda and Volkswagen to set up factories there. So the trade barriers and the market entry barriers for China is just going to keep going up in the coming years.
Right, and as you said, Chinese EV stocks under pressure here, big losses over the past 12 months. That was our China correspondent there, Min Lo, and some other top geopolitical stories that we're tracking this morning. And the US has criticised what it calls China's escalatory actions in the South China Sea after recent clashes with Philippine ships and crew. The State Department says Secretary Antony Blinken has repeated Washington's ironclad commitment to its defence treaty with Manila. The Philippines says a crewman lost a finger on Monday when a military resupply mission clashed with armed Chinese forces near a disputed shoal. And the Philippines is reportedly reinforcing a broken-down warship that serves as its toehold in a disputed part of the South China Sea. The Financial Times says the Philippine military has conducted missions in recent months to bolster the rusting vessel amid fears it's in danger of breaking apart. Manila ran the ship aground in 1999 to reinforce its claim over the area, which China also says is part of its territory. An Israeli military commander has appeared to suggest that Prime Minister Benjamin Netanyahu's goal of destroying Hamas is unachievable. Rear Admiral Daniel Hagari told Israeli TV that Hamas is an idea and anyone who thinks that it will vanish is mistaken. Netanyahu, meanwhile, says Israel will not leave the Gaza Strip until Hamas's military and governmental capabilities are eliminated. Russian President Vladimir Putin isn't ruling out providing North Korea with high-precision weapons after signing a defense pact with Kim Jong-un. Putin says Russia reserves the right to supply arms in other regions, comparing it to Western nations' military support for Ukraine. The Russia-North Korea pact is also prompting South Korea to consider ending its own ban on sending lethal weapons to Ukraine. We'll have more ahead. This is Bloomberg.
Well, Oaktree Capital Management's Howard Marks says that they're not backing away from loan investments in China. The investment manager's co-chair also told us exclusively how the company handled the fallout from Evergrande's downfall.
Given that the U.S. is priced highly, a lot of the opportunities for bargains are outside the U.S. Obviously, China is on a lot of people's uninvestable list. That tends to depress its value, and we like to look at things that other people aren't interested in. So China is one good example. But you know, we are not macro investors. We're not top down. We don't affect a geographic diversification for its own sake. We go where the bargains are, and we're finding lots of bargains in many places.
And Howard, you mentioned about China giving you good opportunities outside the U.S. I mean, in particular, I know you guys focus more on the loan side of things when it comes to your distress strategy in China. I mean, how are you viewing distressed properties now in the mainland? Is there a sense that you're adding to your exposure in any way or backing away from this sector now?
Well, you know, we've been investors in NPLs for close to 10 years, non-performing loans, that is. Every banking system generates some non-performing loans. China has set up mechanisms to get them off the bank's books. And we've been participating for, as I say, close to 10 years. The legal system has operated as it should. We're happy to continue in that role, and we're not backing away.
In terms of, I mean, obviously you were kind of caught up in what happened with Evergrande as a creditor. I'm just wondering, were there any lessons that were learned from this fallout from Evergrande and this downfall, and how much of the assets was Oaktree able to salvage?
The lesson is to be careful when supply is created by strong availability of capital. Capital was made available to the property development sector so that it could contribute to GDP growth. It expanded rapidly. It made use of that capital. It built some buildings which from time to time turned out to have supply exceeding demand. We participated. I think another important lesson is it's a good idea to get collateral. We got collateral on our loans to Evergrande when many others didn't. And we think we're coming out very well. As I mentioned, the legal system is performing for us. We have gotten control of the collateral, and there haven't been any disappointments on that front. So, as I say, we're continuing with our involvement.
That was the Oaktree Capital Management Co-Chair Howard Marks speaking exclusively to us earlier here on the China Show. Quick check on how markets are faring. We're 9 minutes into the trading session, or rather 1 hour into the trading session for mainland equities, but a couple of hours into trade for Tokyo, of course. And one of the names in particular we're tracking is SoftBank, because they've got that AGM underway. We've been hearing from Masayoshi Son this morning talking about his plans around artificial superintelligence, saying that that could be realized within a decade here. That sense we're getting as well that SoftBank could be on the cusp of a new major investment. They've also been speaking about ARM and the value that chip designer really brings to the company. Other names we're tracking as well, you can see there's SoftBank a little bit under pressure so far, but relates to Chinese solar stocks. These are actually moving in a very different direction. It's overall a weaker session here for Chinese equities, but these are moving high here because we're getting some lines coming out in terms of further investment guidance. We know that the Chinese solar sector has really been calling out for help from Beijing, given there are so many concerns around overcapacity and also geopolitical tensions as well to note. So we're getting these lines dropping around more guidance capacity expansions, and also to avoid any sort of redundant investments that we see in the sector. Earnings as well are focus, and one of those is Vitasoy, where we've got that company reporting yesterday after the bell. We actually saw those numbers coming in better than expected, but here you are seeing that stock just a little bit under pressure so far. We're going to be speaking exactly why we are seeing that weakness. We've actually got the Vitasoy Group CEO, Roberto Guidetti. He is joining us here live in studio in just a couple of minutes. We'll have more ahead. This is Bloomberg.
All right, 11:29 a.m. in Tokyo. Japanese markets are going to lunch break there. Not a whole lot of conviction in these markets, but you're seeing a little bit of upside in the topics compared to the Nikkei here this morning. But take a look at dollar yen, 158.90. So we have held at least steady after a 6-day slump here for the Japanese yen. Obviously, there's still a lot of concern now that the U.S. has also added Japan into that FX watch list as well. Yields are taking higher by 2 basis points, but yes, we're getting ever closer to that 34 low or so. 160.20 is certainly what some of the levels that we're watching out right now for dollar yen.
You just wonder how much that's actually helping the Japanese exporters. And you mentioned low conviction. Actually, I was just taking a look at trading volumes here across the board, and we're pretty far off where we would typically be on a 20-day moving average basis. A couple of different sectors are standing out to us today. Actually, pretty much every single one is in the red so far, with the exception of healthcare and consumer staples. But it's really those moves that we've got in the IT space in particular. Overnight, you had that big drop in the likes of Nvidia, for instance. You're really starting to see a lot of investors perhaps just pulling back, taking a breather in the market sentiment so far. But of course, lots of different earnings still a focus here in Hong Kong in particular, and one of those is the Hong Kong listed beverage maker Vitasoy International. It's seen its full year net profit jump more than 150%. Let's get the outlook for its businesses in Hong Kong and also mainland China. Joining us exclusively now is the group CEO Roberto Guidetti. And Roberto, let's just start off bigger picture here. What stood out to you from these numbers, and what were you happiest about in particular?
Yeah, we call it a year of structural improvement. So we, on a like-for-like basis, our revenue grew 1%. We had a little contraction of 3% in the first half, but then second half grew 6%. Mainland China, which is 50% of the business, grew 10%, a very important part for us. And then because of this growth, then we were able on a total fiscal year basis to improve our gross profit. We have a 50% gross profit, which is quite high in the industry, 2.5 points versus last year. And as you mentioned, when you bring it down to net profit, $118 million, a very, very significant growth compared to last year, more than double, basically. And we think that the work that we did in mainland China is particularly important for us. 54% of the group. Basically, the value of the company in the future depends on how well we're going to be doing in mainland China. And mainland China is interesting because we have a position, not yet fully national, and so there is a lot of growth opportunity, to continue to develop. But also mainland China as a market is also a market where in our categories of plant milk and tea is relatively underdeveloped on a per capita consumption basis. So we look at these two basically factors, our geographical opportunity for expansion and the development of the categories to actually continue to drive our growth going forward.
You mentioned Hong Kong, sales growth could be in single digits for some time, and you're not sure when we can get back to those pre-pandemic levels. Why do you think the recovery has been so slow in Hong Kong?
Well, Hong Kong, you mean our business?
Yes.
Our business actually in Hong Kong is done okay. I mean, when we're looking at the group, we had a bit of a contraction in 21 and 22 on mainland China. Hong Kong, I'll address Hong Kong. Hong Kong is a market that is very interesting. We have been in this city and territory for more than 80 years. So you can imagine that the per capita consumption of our equities is very, very high. But what the team is able to do is that leveraging innovation, so every year there are new products coming, the team is leveraging innovation to basically build on top of the existing business. And also the team is able to execute this innovation very, very competently.
Yeah. But are you seeing any signs of a challenging retail sector? We see that in the F&B industry. I mean, how are you seeing it?
Yeah, so Yvonne, our business is operating across a number of channels, And so when we're looking at all the channels, I would say that what we call the on-the-go consumption, like convenience stores, general trade, doing very well.
Yeah.
So maybe there is the sort of southbound from mainland China maybe helping a bit on that.
Yeah.
But basically the on-the-go consumption doing very well. The supermarkets and these kind of outlets which cater to home consumption maybe doing less well. And also the online recently maybe slowing down a bit. So when we look at the business in its entirety is growth. But when we're looking at it across channels, we see the on-the-go be and on-premise be much more vibrant, while the others a bit slower. So how a company is going to perform, it also depends on the intensity of your development in different sectors. Right? We are doing quite okay from that point of view.
Mainland China, you mentioned that there are some categories that are perhaps not underappreciated, but underdeveloped.
Yes.
So which ones are you looking at in particular?
Yes, so our company is a company that focuses on sustainable plant-based food and beverages, all right? And so we have two main categories. One is soy milk in mainland China. In other countries, we also have oat and almond, etc. But in mainland China, soy milk primarily. And then we have ready-to-drink tea. So when we're looking at the per capita development of these categories and we compare versus Hong Kong or versus the Western world or other countries in Asia, it's quite interesting. So mainland China is a big market, but to give an example, if we're looking at liter per person per year of soy milk in mainland China would be 2. Now Hong Kong would be 10.
Oh.
Australia and US would be 5.
Really?
And UK would be 7. So we believe that on this category, it is possible, not as a straight line. It's not going to be automatic every year. The company needs to do a number of things to grow. But we believe that there is a lot of room, not only from a geographical point of view, but from a per capita consumption point of view. And we have a number of models, we have a number of portfolio items that we have not yet marketed in mainland China that we can take from some of our other markets to accelerate a bit consumer adoption.
But how do you grow those? Because, for instance, we had a story recently talking about the explosion of coffee consumption in China.
Right.
How do you introduce these and how do you actually get people to gravitate toward them if you're trying to lift that per litre consumption?
So We see the mainland China market to be in a very, very interesting phase. There have been a number of coverage that appear to be quite gloomy. Actually, the way we look at it in its macro, when you from the macro you go into different segments, is a market that is very exciting and there is growth. So in our category there is growth, 3-6% every year already now. To answer your question about how do we grow it, we think the shopper has become ever more sophisticated, and so brand equity and the ability to build brand is very, very important. The having products which are differentiated, i.e. not just belonging to a category, but really standing out in terms of the product experience becomes much more important than it was in the past. And obviously, as you mentioned in the show a number of times, affordability. Yeah. I would say that affordability over the last 5 years compared to the previous 5 have become very critical. So you might have great equity communication, great product, but if the pricing is not correct, then you will see a slowdown in your development.
I was going to ask you about pricing. I mean, there's barely any inflation in China right now. You're hearing about these steep price discounts across the F&B sector here. Are you feeling the effects of that? Are you pressured to have to kind of lower your prices to stay competitive in this market?
Yes. So I would say that from the point of view, from the encouraging news on this is the fact that it is possible for a company like us to operate with a 50% profit margin, gross profit margin, and yet be competitive on the right segments. But to your point, there has been a significant change over the last 10 years on price points. I'll take tea as an example. Tea as an example, maybe 10 years ago or 10 plus years ago, the idea that you would sell a tea for like a half a liter plastic bottle for more than 3 RMB, no one would dare to do that. No one would dare to do that. That changed when some of the companies started to operate at 4 and 5. And over the years, for a number of years before COVID, it seemed like the only way was up. Yeah. So all the innovation that was regularly delivered every year would appear at a higher price per case. But now, basically, from the sort of 7 or 8% RMB per bottle, it has come down to 5. And so a company needs to be able to manage a portfolio, not only in terms of list price, but in terms of promotion, timing, and identification of the right channel to stay competitive and operate in the segment that is more that has more momentum.
What about brand strategy? We're hearing from Sasa, the beauty retailer, in the last hour, talking about consumers being more willing to try niche products. At the same time of that, you've got a real preference for some Chinese consumers to go toward Chinese brands.
Yes.
How are you leveraging the Hong Kongness of Vitasoy, and is that enough for mainland Chinese consumers as well?
Yes, we're very happy to be a Chinese company in this context. Okay, and I think when you're talking about innovation and the innovation that is working, I would say we have a very vantage point of being very sizable in Hong Kong, but also very sizable in mainland China. And we can see how some of the trends are going to be different, some of the relevance are going to be different. I'll give an example. We launched a oat platform. You will remember that a couple of years ago, oat was very hot, right? So we launched the oat platform. The oat platform has done very well in Hong Kong. Mainland China, less so. So we have established, but less so, because the image of dairy in mainland China is much more positive than in the Western world. And the choice on plant-based other than oat is also very, very wide. And so the ability for a company to understand that there is an innovation that technically could work, but because of local market condition might have less potential is very critical. Recently, and what we are putting to the market over the last 2 months are a number of items that we think are more in line with our core business. So, for example, on the Vitasoy classic line, we launched a banana flavor, we launched a strawberry flavor. These might appear very simple, but they're very, very welcomed by the shopper, okay, and they generate incremental business. On tea, we have launched no sugar. On our iconic brand of lemon tea, we launched a zero variant. Okay,
because thank you for doing that, by the way.
Very good. Yeah, I'm glad that.
And the sparkling one.
And the sparkling, yeah. So these are examples about innovating, but innovating in a way that is close to your core, makes it relevant, also makes it quite straightforward to execute for the sales team.
Yeah. So what else is next in innovation then? Are you thinking about rebranding, staple products? I mean, looking at new sort of...
Well, we have 2 main brands, okay? So Vitasoy is one brand that covers the plant milk area, and then in tea, we have Vita. I think that some exciting things, Belle was mentioning Australia before, some exciting things happen in Australia on this space. Okay. In Australia, we have a yogurt line, and actually the yogurt line is, one is soy and one is oat. outstanding products. So these are some of the things that maybe when you look at them in the context of Asia might be ahead of their time.
Yeah.
It is important for us to educate, prepare, and then launch. But in the context of Australia, very successful.
Bella was saying it's quite competitive in Australia.
Very competitive market.
Very competitive.
Yeah, for soy milk in general. There's so many options now, and it's really grown that category.
Yeah.
You go to the coffee shops in Melbourne, and then you will have every coffee shop to have dairy, low fat, soy, almond, and oat.
Yeah.
They must have, because the consumer wants to have that choice.
Roberto, it's great to have you. Thank you so much for giving your perspective. Roberto Guidetti,
very much.
Group CEO at Vitasoy International Holdings. Of course, you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter out every Thursday. You can sign up through the website, Bloomberg.com/newsletters. Plenty more ahead. This is Bloomberg.
It's a good idea to get collateral. We got collateral on our loans to Evergrande when many others didn't. And we think we're coming out very well. As I mentioned, the legal system is performing for us. We have gotten control of the collateral, and there haven't been any disappointments on that front. So, as I say, we're continuing with our involvement.
That was Oaktree Capital Management's Howard Marks on lessons learned from Evergrande's collapse. And let's stick with the property sector because we've got 4 defaulted Chinese developers heading into Hong Kong court hearings next week on liquidation demands. Let's get more with our bond and loan reporter Loretta Chen joining us here in studio. And Loretta, we're calling this a make or break week, but who's in the spotlight here in particular?
So there are 4 developers. 2 are the ones we have talked about over the past 2 years, Kaiser, which defaulted in 2021, and Shimao Group. So Shimao is its first ever court hearing after the winding up petition was filed by Chinese state bank CCB Asia. And then Kaiser, we've heard it defending itself against the winding up hearing before in April in Hong Kong court.
So what are the chances that these developers are actually going to get a winding up order? What do we know so far?
Yeah, so it all depends on how much they've done with their restructuring. So Kaiser has not been able to put up an official restructuring plan to its creditors, but in the last April hearing in Hong Kong court, it's told the judge that everything is proceeding as planned. So it seems like there's a likelihood that it's going to propose something very soon, and that could help it fend off that winding up petition. And on the Shimao front, it actually proposed a restructuring framework earlier this year, but that was actually being voted against by the creditors. So it seems like the creditors aren't happy with the current plan, and we haven't heard any updates on how they're going to deal with these disagreements. So for Shimao, I think there's still risk there, these disagreements eventually leading to even a potential winding up order.
Yeah, it's that real liquidity crunch focus for a lot of companies. Vanke, of course, is one of those, and we're hearing from sources that maybe it's looking at a new way to try and raise some cash.
Yeah, exactly. So Vanke has this rental unit called Boyu, and it's trying to list it via a real estate investment trust in order to get more equity capital. And I think in this story, actually, it's quite lucky for Vanke to be able to capitalize on these commercial assets, because different from the residential properties that it needs to just generate the sales, you can actually rely on rentals. And throughout the property crisis, we're seeing these developers with more of these income-generating commercial properties actually faring better than their peers. So it's a good news for Vanke, and I think it's trying to explore different ways of raising cash.
All right, Laura, thank you. Laura Chen there. We'll let you go because next week's going to be pretty busy for you, it sounds like, with what's happening in court here. Some updates on the property sector in today's financial papers as well. Here is your China brief. State media outlets are reporting a meeting held by the Housing Ministry on turning unsold commercial property into affordable homes, and officials are reportedly told local governments to carry out the plan, quote, vigorously while accounting for local real estate market conditions. Now, the measure was announced last month as part of a broad property rescue package. That package also includes cutting mortgage rates. The Securities Daily now reporting that many customers are repaying their home loans early to avoid servicing their existing higher interest debts. And it also says calls are growing to reduce rates on existing loans.
Yeah, lots of different movers we're tracking this morning as well, and one of those is Evergrande's new energy vehicle group. You can see here surging more than 40%. The reason why we're seeing this surge, we're still not 100% sure on that one, but certainly this is a company that has really seen, or a unit that's really seen very whipsaw trading. Just a couple of days ago, it was ordered to return all of its state subsidies, so it really just adds to the woes that are facing China's Evergrande as a group level as well, but we have seen that really moving around today, though, surging more than 40%. We'll hopefully get more details on that ahead. This is Bloomberg. Taking a look at some live pictures here, you've got SoftBank's AGM still underway this morning in Tokyo. In live pictures there of the founder Masayoshi Son here speaking this morning about his plans for artificial intelligence. This has really become centre to SoftBank's focus here. Perhaps they could be looking to make a major investment in the AI space, and actually Son himself this morning has been speaking about the outlook for that technology, saying that we could see superintelligence coming within the next decade. That certainly is his primary focus, because some of the other lines that are dropping from this include share buybacks and splits. These are things that he conceives or believes to be minor matters. SoftBank here, you're seeing it actually trending low. It was earlier in the green, but now dropping nearly 2% at this point in the session, Yvonne.
Yep. Checking some other corporate stories as well this morning. TikTok and its China-based parent company ByteDance are arguing that Washington could have enacted less restrictive alternatives to address national security concerns. In a court filing, they say the U.S. government has multiple layers of safeguards, but Congress instead enacted a ban earlier this year. TikTok has maintained there is no evidence the app poses a national security threat. Swiss watch exports fell in May due to a persistent slowdown in demand for premium timepieces in China and Hong Kong. The Federation of the Swiss Watch Industry says shipments by value fell 2.2% to around $2.6 billion. Exports to mainland China were down 18%, while sales in the key trading hub of Hong Kong slumped close to a quarter. And yeah, speaking of premium products, right? This Kweichow Moutai, slump seems to really continue here. And obviously, you take a look at just the milestones it's reaching. I mean, the worry about these wholesale prices falling and what this means for the whole consumption recovery is really weighing on investor sentiment here. And now we're seeing the likes of ICBC getting ever so closer to taking the crown as the most valuable company in China.
Well, that's right. I mean, Moutai was really seen as sort of that barometer for consumer sentiment here, but there's just been so much concern around that weakness that you've seen in wholesale prices in particular, and that has really also led to concerns around the margins and how those are going to be impacted. Of course, that is really, as we said, a barometer of that sort of broader aversion that we're seeing toward premium brands, and it has been that story of Chinese consumers perhaps out, but they're choosing smaller ticket items. ICBC, for its part, though, of course, is a bit of a different story, because we've really seen those more shareholder-friendly policies taking hold, and that's really benefited the stock as well.
Yeah, this whole dividend play, the banks are certainly back in focus on that. But yeah, it's interesting you mentioned 1.88 trillion yuan. That's where the market cap sits on Moutai here right now. I think we're just about 26 billion away, renminbi, from ICBC taking that crown. But certainly it's interesting, just goes to show, I mean, foreign owners, investors used to it was almost like a staple in portfolios. And now we're seeing foreign ownership of Moutai stock. I believe it's the lowest that we've seen since January already.
And actually, I'm just taking a look at the slide we've seen as well, because you're actually on track for 8 straight days of losses here. And looking across the last, say, month or couple of months of trading action, it's been a lot more days in the red versus ones in the green. So certainly that is a very challenged company for the broader Chinese equity space. But let's actually just take a look as well at what we're seeing, because broadly we do see markets under pressure this morning. You're also keeping an eye on what's happening in the currency space and the moves that we've seen in the Chinese yuan in particular.
Yeah, so everyone was thinking yesterday after that weaker fix that, What's going on? Are they letting the currency go? And then you start to see right now that no, that's not really the case here from the message from the PBOC and the fix here today. We saw the strongest fix since April today to maybe offset some of the weakness yesterday. But it looks like they were just taking a slow day when U.S. markets were closed to maybe let a little bit of steam. They're just, Barclays had an interesting note that's saying given how wide that yield gap is between the U.S. and China, the renminbi should be actually weaker, but the PBOC is keeping that still stable at this point. So letting a little bit out is not something that is a surprise to them as well. But yes, it's not just the renminbi story, it's the yen as well. Those two things that are, the market's really watching out for here today.
Yeah, that's right. I mean, the yen we've been talking about, we're just trading very close to that 160 mark at this point in time. Japanese yen, of course, at these levels, it's been something that's really supported Japanese exporters in particular, has been perhaps one of the reasons that we've seen those moves higher. But it's also that just story of king dollar that's really feeding across, and that's also a reflection of those central bank decisions that have led to king dollar strength. But FX is there. Let's also just a quick check again on what's happening in the equity space, because the CSI 300, we're actually below a key technical support level now.
Yeah, so we talk about 5 weeks of losses that we're set for, which is the worst sort of streak that we've seen, or the worst week in 2 months, I believe. But yeah, when you take a look at the technicals, we're basically stuck between that 200 and 100-day moving average and sort of approaching oversold levels here right now. So you got to wonder if people are buying into this weakness here. Hang Seng, though, things are looking a little bit better. In fact, we've rebounded and we actually touched above that 50-day moving average, Bell.
Yeah, and of course, Hang Seng really caught between what's happening in China and also the moves to the Fed, and the tech sector really one to watch there. We are seeing that really leading some of the losses today.